Good day, everyone. My name is Rebecca Lilly with the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Climate Transition Risk in New Zealand Equities. We are grateful to Ivan Diaz-Rainey from the University of Otago for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our speaker. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for Ivan, please click the Q&A button at the bottom of the Zoom window and type your question. We have allocated time at the end of the webinar to read and answer them. And now I would like to introduce you to our speaker, Dr. Ivan Diaz-Rainey, the Director of the Climate and Energy Finance Group and Associate Professor of Finance, University of Otago. Ivan, over to you.
Thank you, Rebecca. It's a real pleasure to be with you again. And yeah, let me just start off by sharing my screen and make sure the technology is working. Yes, so thank you very much for that introduction. It's a pleasure to be here. And I guess I've got about 40 odd minutes to go through what I'm going to talk about today, which is climate transition risk in New Zealand equities, which on the face of it doesn't really have much of an energy story if you just look at the title. But as we dig deeper, you'll see that actually there is an energy story. So it's about greenhouse gas carbon footprinting. And for most corporates, that's around their energy use. So there is an energy story underlying it. Actually, in New Zealand, the story is slight and different to most other countries, and I'll explain that. This is work with Hamish Kennett, who was a student here and has moved on to the corporate world, Palab Biswas and Daminda, both colleagues here in the Department of Accounting and Finance. As Rebecca mentioned, I lead up the Climate and Energy Finance Group here at Otago. You can go and check out our website if you're interested in the area of climate finance. Actually, we have an event on next Thursday and Friday, which is our first climate and energy finance symposium. It's free. You can register. We have some great speakers, including Sean Kidney from the Climate Bond Initiative. And with various contact details if you want to be added to our mailing list. All right, but the menu for today is fairly standard. So I'll do an introduction. I'll provide a little bit more context on the New Zealand context, and I'll talk about the data and models that we use, the results, and draw some conclusions. All right, the focus of the paper is to examine climate transition risk in New Zealand equities. So when we talk about NZX 50, these are the 50 largest companies. Actually, our sample has 54. I probably need to clarify why that is, but anyhow, it's the largest companies in New Zealand. The fact that our primary index has 50 or so companies in it tells you that New Zealand is a small country. But as I'll show you, hopefully, it's interesting for several reasons, and it's around transition risk. So if you take Mark Carney's taxonomy on climate risk in financial markets, he talks about transition risk, liability risk, and physical risk. Physical risk is obviously perhaps the easiest to understand, which is assets being affected by extreme weather events, hurricanes, and so on. Liability risk is insurance claims and litigation, and transition risk is that transformation from a carbon-centric or a greenhouse gas-centric economy to a low-carbon economy. Transition risk has been proxied by practitioners like BNP Paribas through greenhouse gas footprinting for corporates. Um, I think this is quite crude. Transition risk obviously involves a whole range of things, including consumer preferences, but it's measurable, and it probably captures 60 to 70% of in terms of climate risk, at least what firms are doing. Greenhouse gas footprinting is a good way of going about it. And as I mentioned at the very beginning, for most greenhouse gas footprints is really around energy use. So the preponderance of the footprints will be around energy use, or bought electricity, or upstream and downstream energy emissions. So one of the things, so we've had some stuff like the TCFD. So this was the Financial Stability Board recommended that investors use this taxonomy to look at how much risk, how much climate risk is in their portfolios. So if you put these bits together, that in terms of transition risk, most of it is around greenhouse gas footprinting, and most of that is around energy use. Suddenly you've got investors very interested in the nature and extent of energy use by corporates. And by nature, I mean, is it carbon intensive or not? I should say in this analysis, so we list companies, and I should have a caveat. Our analysis is based on data from 2010 to 2018, and for some companies, their carbon footprints has changed materially since. And when we first did the first iteration of this paper, generated quite a bit of interest in New Zealand, and some companies were rightly keen to point out that we should clarify that. So I'm clarifying that up front. So these are largely historical results, and I'll talk about a couple of companies that the carbon footprints has changed materially since. So, but actually for me, it was a really enlightening thing how focused companies are on this, and I'll explain a little bit more why that might be in the case of New Zealand, because there's building momentum in this area. Our analysis has 4 components. So we developed this greenhouse gas footprint for corporates, and I'll talk more about what that was involved. Predicting emission disclosures. We had a model to try and figure out, well, what are the characteristics of the firms that do disclose? And then we calculate something called a hypothetical carbon liability. And this again comes from what BNP Paribas has been doing. They're one of the leading banks in the world in terms of understanding climate risk. And it's really, well, I'll show you the equations. It really is trying to, it's a sort of hypothetical exercise to see how exposed firms are to climate risk. And then finally, we do an empirical asset pricing to see what effect carbon prices have been having on asset returns in New Zealand, because New Zealand has a carbon market. So which takes me neatly onto the New Zealand context. So in the working paper, we note that there's really 3 main reasons why New Zealand is an interesting context to do this. One of the reasons, and I've intimated this, is that our greenhouse gas profile is quite different to other developed countries. So in most countries, the carbon footprint, or the greenhouse gas footprint, to be precise, would be in the region of 80% from energy from carbon, whereas in New Zealand, actually agricultural emissions make up over 50% of our greenhouse gas emissions. So stuff like methane are particularly important. Probably explained by the fact that we have 6 million cows and 5 million people, so we have more cows than people, and we have over 26 million sheep versus our 5 million people. So yeah, you start to understand that our greenhouse gas profile is quite different to other developed countries, which poses challenges. Also, we have our green and clean image, and that partly comes from a renewable system that actually came from heavy state interventionism in decades gone by. So we have 85% renewables, which makes us look very clean and green. The reality is slightly different when you factor in these agricultural emissions, actually. So if you take it per capita greenhouse gas emissions, we are actually amongst the highest in the world. So that makes us less clean, shall we say. We also have a particularly inefficient car fleet, and we use a lot of process heat, often to turn the milk that our 6 million cows produce into milk powder, and that's quite an energy intensive process. So you'll see us, once we start talking about greenhouse gas profiles, the conversation often turns to energy discussions, but also in the context of New Zealand, we have also a lot of methane and other agricultural greenhouse gases. So that's the first factor. The second factor is that New Zealand has priced emissions since 2008. So the ETS was meant to be an all sector, all greenhouse gas emissions system. That never quite happened, and it's really largely carbon that's been in the scheme, and therefore energy. And so, we're 85% renewables already, but there are these other components like energy use for transport, and actually that's being one of the major factors increasing greenhouse gas emissions, or the fact that has been increasing in terms of greenhouse gas emissions. Actually, our electricity system has been becoming less energy intensive as well. So we've been having more geothermal and more wind power. So we have the second oldest national ETS. We do quite a bit of work on ETS in my group, yeah, so it's interesting. But so that feeds into the part 4 of our analysis, which is the asset pricing element of it. Also in New Zealand, there's been this big push to greening. I should really put the economy rather than just the financial system. Big push to greening the economy. Probably starting, well, not starting, but a big momentum and a big change happened in 2017 with the creation of the Climate Leaders Coalition. So this was a lot of the big corporates saying that they're going to start reporting greenhouse gas emissions. So that's very relevant for our footprinting exercise in this paper, and also trying to reduce their greenhouse gas emissions and setting targets. And I think the aim is to be consistent with the Paris Agreement. Then in 2019, so we obviously had sort of Jacinda Ardern's, Prime Minister Jacinda Ardern's government come in, and they were in coalition with the Greens. And so the big success there was the establishment of the Zero Carbon Act, which aims to have zero carbon by 2050, and an independent climate change commission to implement or to oversee that transition. Actually, it was I guess for those that may be from the US, there was political consensus achieved across the parliament on this. I think there was 1 or 2 dissenting votes, but pretty much every party, or all bar 1 or 2 parties, smaller parties. So a couple of, I think one maybe ACT, small party objected to the Zero Carbon Act. Don't quote me on that, but generally we had consensus on moving forward in this. 2019, 2020, there was something called the Aotearoa Circle Sustainable Finance Forum. I was part of a technical working group there, and that was looking at specifically greening the financial system. And in 2020, just before the election we just had, the government announced that they would be mandating TCFD reporting by 2023. And that's for any institution with 1 billion worth of assets. So that has a big impact on the banks. And, even before then, we have, New Zealand has a sovereign wealth fund called the NZ Super Fund. And they're one of the largest, I think now the largest investor in New Zealand equity markets, and they were a founding member of UNPRI. So they've had, even well before, decades before this new momentum that emerged, they've had a suasion effect on trying to get corporates to engage on ESG, environmental, social, and governance issues. So that gives you a sense of the New Zealand context. These are the price of NZU. So this is from New Zealand's emissions trading scheme, and we call it the NZU Smile. So the system is introduced, prices collapse for various reasons. There was political change, and obviously the GFC around 2008, and then gradually prices have recovered. So this is relevant to the asset pricing analysis that we do and the hypothetical carbon liabilities. Actually, this goes up to 2019, but today carbon prices are 35 New Zealand dollars. So they've reached a fairly high level already. So again, my caveat, this is based on data. Oh, sorry, that should be 2010 to 2018. So what we did, what Hamish did was to try and compile the largest, the most comprehensive data set of greenhouse gas emissions footprints for New Zealand corporates. We did that from a range of sources, or he did that from a range of sources, from annual reports, from the Carbon Disclosure Project, from DataStream / Asset4 and CMAR. And so we got all of those, and we had still quite a few missing values. So we contacted the companies, and quite often we got some additional disclosures that way. They pointed us to reports that we hadn't found on their websites, and so that made our data set a little bit bigger. And we also use averages, industry averages, where there's an adequate comparison. So we try and fill in the blanks where there's adequate comparables. And so to be clear, what we mean by corporate carbon footprints. So we have the carbon corporate footprint accounting standards, which is Scope 1, Scope 2, and Scope 3. Scope 1 is classified as direct greenhouse gas emissions from sources that are owned or controlled by the companies. Often this is around energy and energy use, so vehicle fleets that companies may own, any boilers that they own and combust to generate process heat or generate electricity and so on, or heat buildings. Scope 2 emissions are classed as indirect emissions coming from purchased electricity. And again, in New Zealand, if we go back 85% renewables, then this should not really be a particularly big issue for most corporates. Most of our energy mix is reasonably clean. Then you have Scope 3 emissions. So these are other indirect greenhouse gas emissions occurring from activities of the company, but not from sources owned or controlled by the company. So obviously, Scope 3 is the one that's probably hardest. And so when we look at emission intensity, we don't particularly look at that, because there's a problem of double counting and so on. So we don't use those. We do use them in one example. And so, when we're confident that there isn't double counting. So if we take upstream, let's say agricultural greenhouse gas emissions, we show one example there related to our biggest cooperative dairy firm, which is Fonterra. So those are greenhouse gas emissions. It was really interesting, the data. I mean, it was really hard. We've had lots of issues with data inconsistency across different sources, where there were multiple sources, firms that report for 1 year and then don't report again. So yeah, it's not clean. It's not clean. And so I guess in this sense, the fact that the government is moving towards TCFD reporting is a good thing. Yeah, hopefully it will create some standardization. It will mean all firms will eventually report. But the real cost for firms in doing this exercise, it's not cheap to get your carbon footprint calculated. When Hamish was approaching companies, a few of them said, would he do the footprinting for them. So clearly it's a problem that they have, and we'll see in our predictive model of what drives emissions. Then size and profitability are important. So stealing some of my punchline there, which again takes me to the model that we run. We run a logistic model. We pull that data from 2010 to 2018, and so one is that they report greenhouse gas emissions. We have total assets in there to measure size, return on assets to measure profitability, firm age, if they are in an energy intensive sector, and are they members of the climate change coalition, which is that group that was established in 2017, a group of corporates that said that they were going to move towards reporting and trying to reduce their carbon footprint. So you would expect a priori that members of the climate coalition would be more likely to report. We also have not country dummies, year dummies. And again, we would expect that over time, after 2017, the likelihood of reporting increases. Then we have a hypothetical carbon liabilities. I notice I don't have too many references in here, and perhaps is a good point to talk about academic positioning. From a purely academic perspective, there aren't many country studies on greenhouse gas footprinting. I mean, there's quite often sectoral ones, but there are not many country studies, and one reason for that is that it's difficult to look at across sectors. They're very different, but it's important because actually most investors are still defined by national geography. So that's probably should have mentioned that in the introduction. The second part of the analysis is, or the third part. So the first part, sorry, was to build this data set. The second part was to do these logistic regressions. And the second part is to calculate these hypothetical carbon liabilities. And so what we do is take scope 1 and scope 2 emissions and multiply them by some carbon price, which gives us a carbon liability for firm I at time t. And so what we deduct is that carbon liability from revenues, and then calculate the percentage change, right? And these are calculated for 2018. So we use 2018. In this exercise, we used 2018 greenhouse gas disclosures and prices at 2018, and then we use prices at 2030 and 2050 from an exercise that was done by this body called the Productivity Commission Low Emissions Economy Final Report that had these carbon price scenarios. There's two transition pathways, PD 25, PD 0 scenarios, and they come with different carbon prices. So we plug these numbers to see these carbon prices. So I think the highest one in 2050 is 200 New Zealand dollars a carbon price, and to see what that has on firm revenues, assuming greenhouse gas emissions stay at 2018 level. We use revenue to see, to get a sense of scale, right, of how exposed these firms are if they didn't change over time. So it's not an actual carbon liability. I should make that absolutely clear. It's hypothetical. And actually, of the 50 odd companies that we have in our sample, I think only it was 7 are actually reporting members of NZETS, so New Zealand Emissions Trading Scheme, because it's quite an upstream scheme. So it would be the energy companies. So we implemented quite an upstream emissions trading scheme. So emissions trading schemes can be upstream, midstream, or lower downstream. But New Zealand's one is generally quite upstream. So it is very much a hypothetical exercise, I should note. And so these are the pathways. So we used $25 for 2018. $55 and $80 for 2030, and $142 and $200. Yeah. One of the other things here that to emphasize is that it assumes a zero cost pass-through. Yeah, so if firms face these carbon prices, they would obviously pass them on to consumers. So there's quite a few assumptions here. One, that we use baseline 2018 emissions, that there's zero cost pass-through. Yeah, so it's a very simple exercise, but it's about getting a sense of the scale of which firms are most exposed to climate transition risk as measured by greenhouse gas emissions. So the final part of the analysis, so as I mentioned, the first bit was to set up a data set. Second bit was to establish the logistic models on predicting disclosure, then our hypothetical liability. And then the last bit was a sort of an empirical, to what extent have carbon prices and carbon price volatility affected asset prices. And so we use an asset pricing approach with Pharma French for factors, the market return, small minus big, high minus low, momentum, and here we have our carbon risk, which is calculated on daily closing prices of New Zealand units from the emissions trading scheme. And we also have the risk factor, the standard deviation of daily returns. Risk of or volatility of carbon prices, which comes from an AR1 GARCH 1.1 process. We also look to see, because our initial results showed that, at least in terms of carbon price, was having little effect. So we also calculated a carbon price high low, which was created by adding or subtracting one standard deviation of the median carbon price during the sample period. So we look at whether carbon price is having an effect and whether carbon price volatility is having an effect, and extreme movements in carbon prices are having an effect on stock returns. Cool. All right. So these are our descriptive results. So we have firms that report more than 2 years of emissions for our sample period. So up to 2018. 2010 to 2018, those 9 years. Firms that report only 1 year, and firms that hadn't reported up to that point. As I said, TCFD mandatory reporting will mean that by 2023, every firm has to report. And straight away, you see a sort of a size effect here, where clearly larger firms would seem to be more likely to report, and we formally analyze that. The other thing is, so who are the firms that have the highest carbon intensities? So on our y-axis, we have carbon intensities. We have those that have owned fossil fuels. And again, these are historical, 2010 to 2018. Actually, if you just use 2018 on this, a lot of the energy companies start to drop out, which goes to my point early on that there has been considerable greening of the energy system over the last 9 years or decade, as fossil fuel plants have been closed and more wind and geothermal has been used. So just to emphasize, this is definitely historical. So we have, for instance, Vector there, not the highest by any measure, but they've recently divested from a gas plant, which would wipe out about 83% of that. And I don't think that's due to come through till they report in 2021, I believe. So, and also there's an energy company, which is the largest energy company, which isn't here, which is Meridian, right? Which isn't in this list of firms with the highest intensity, and that's because they're 100% renewable. And this firm, its stock price does incredibly well, because I guess it's 100% renewable firms, and international investors with a UNPRI ESG lens clearly like that. So the other thing is to note, we also get Sanford is a fishing company, and Fonterra is this cooperative, but it also has it's a complex corporate structure. It does have shares listed on the stock exchange as well. Do register that, but no, this is for scope 1 and scope 2, and yeah. So you see New Zealand's unique greenhouse gas profile. As I said, some of these energy ones will drop down, and Air New Zealand clearly will drop down post-COVID, but presumably once we all start traveling again, will recover as well. So these are predictive disclosure results. We have the marginal effects, we have the coefficients there, and I guess the biggest items here are the bigger the firm is, the more likely they are to disclose. The more profitable, the more likely they are to disclose. So, but size is clearly, in terms of the marginal effects, clearly highly significant. We have a marginal significance for intensity sector, but again, also a strong result for if they're members of the climate coalition. Also, over time, you see that the likelihood of reporting is increasing, with the year dummies highly significant post 2014, and yeah. So you see this gradual increasing of reporting. So this is so that was the second part of our analysis. The third is these hypothetical carbon liabilities. Yeah. So let me take a step back and just refresh your memory. So this is where we created these carbon liabilities, scope 1 and scope 2. We multiply it via a range of carbon prices and deduct that from 2018 revenues and calculate the percentage change to figure out, get a sense of which firms might be exposed. And again, so it sort of mirrors what we had in this graph, but it gives us a sense of scale, right? If firms were not passing on these carbon liabilities, if they weren't transitioning, it would wipe out, in the case of Genesis in 2050 at a $200 price, it would wipe out 19% of revenues, right? So which would probably surely wipe out any profits. But there's strong assumptions there. Of course, there's cost pass-through, and of course, firms are very busy trying to figure out how they're going to transition. In terms of New Zealand, as I mentioned, most of these are on scope 1 and scope 2 and based on 2018. But in addition, we did this additional exercise where we added scope 3 for Fonterra. And so these are upstream, and these are really farm level emissions, agricultural greenhouse gas farm emissions, and so you see that actually if you add those, and they're not double counted, right? Farms do not report, they're not part of the emissions trading scheme. So if you were trying to make sure that they were captured, then you get a sense of that that our agricultural emissions matter, and they matter a great deal, right? So beyond Genesis, there really isn't a comparable firm with that level of exposure if you add those upstream emissions. Then these are our carbon asset pricing models, and what we find is that carbon price has no effect for some of the biggest firms. We don't report all of them. The table would become impossible, but really it has no effect. The volatility or the risk, carbon volatility does have an effect. So carbon level doesn't seem to be, or carbon prices don't seem to be priced, but the volatility is, and so are the low and high carbon prices. So low and high carbon prices seem to be priced in. So, I guess one of the conclusions here is that carbon prices aren't having a huge effect on stock market returns, and it's really only very high levels of volatility and very high changes on carbon prices that would seem to have an effect on carbon on stock returns. So to conclude, I'm probably quite ahead of time, but I'm sure. To conclude, really, most comprehensive, I think we've constructed the most comprehensive data set of NZ greenhouse gas emissions for the NZX 50 companies. I would emphasize it was a messy process. There was big differences between certain data sets. In fact, we're still working on it in the lead up to this presentation. We found a few gremlins and well, corrected the ones we know about for this presentation. But yeah, we still need to look at it. Clearly, firms are struggling, and even the firms that take the data from the companies that take the data from the underlying reporting companies have sometimes problems interpreting them. Only 65% of NZX companies disclose their emissions, but it does cover, they are the larger ones. It covers 93% of market cap. So there's still a good number of firms to report, but in terms of market cap weighting, most of it is covered. In terms of our hypothetical carbon liability, and again, it's on 2018, the firms most exposed are Genesis, Air New Zealand, and Contact. But when we add scope 3, and so in New Zealand, this is a big issue, right? When do agricultural emissions get covered under the emissions trading scheme or some other policy? And there is that sort of conversion of agricultural emissions into CO2 equivalents, and there's quite a debate on what that conversion factor should be. And clearly the world gets food out of these agricultural emissions, so the ability to mitigate them is obviously less easy than, let's say, energy-related carbon emissions, and there's some interesting research in New Zealand around genetic breeding of cows and sheep so that they emit less agricultural greenhouse gases. So it's actually an opportunity for New Zealand to be at the leading edge of reducing agricultural emissions. So most countries are still busy trying to decarbonize their energy system, and that's going to have the easiest way and the biggest gains for now, but eventually they're going to have to start looking at other sources of greenhouse gas emissions. And yeah, one of the ideas is for New Zealand to be at the cutting edge of that process. Yeah, I believe that creates a significant opportunity for New Zealand. In terms of our predictive disclosure model, larger, more profitable companies and companies in the intensive sector, and those that are signatories to the Climate Coalition, the Climate Leaders Coalition, are much more likely to disclose. In terms of carbon prices, so our asset pricing model suggests that carbon prices have had little impact on asset returns to date. And actually, our hypothetical liability suggests that actually even quite high prices or quite high prices on carbon markets will really not affect hugely most firms, right? It's really only a group of 3 or 4, and as I said, for some of these, they've already reduced their greenhouse gas emissions substantially. So even a carbon price of 200 doesn't have that much of a huge impact. So it puts into context some of the pushback that firms are giving towards carbon prices, right? And we think of carbon prices at 35 at the moment. For firms at a 200 carbon price, it probably doesn't have a huge impact on those firms, for most firms in the NZX 50. So yeah, it puts that pushback into context. And I guess firms are helped by the fact that scope 2 emissions, those bought electricity, are already relatively green. And I think that covers my presentation for now. Thank you, Rebecca.
IAEE wishes to thank Ivan Diaz-Rainey for an outstanding webinar. This webinar will be available on IAEE's website for future download. If you're not a member of IAEE, we encourage you to join by visiting www.iaee.org. We thank you for attending, and I officially close this webinar.